Hey, my name's Rajesh. I am a direct lender based in Los Angeles, and today we'll be looking at a 23-unit building in Los Angeles and seeing how we can turn 6 million into 9 million in 2 years and get a 58% return on your money every year, basically. I don't know how I could have said that better, but I'm just going to leave it in and we'll go to the video. Let's get into it. Today we're going to be looking at multi-families, commercial multi-family buildings in Los Angeles, and seeing what we can do with an agency or bank loan, because the interest rates are generally better on those without any points to have to buy it down, and but the underwriting standards are much stricter. They are based off NOI, not gross rents. So when doing a normal DSCR loan on a 2 to 8 unit multifamily building, we look at the gross rents and divide that by the PITI payments. And PITI stands for property taxes, landlord insurance, principal, interest, property taxes, and landlord insurance. So that's PITI. So gross rents divided by the PITI payments. With agency loan, we're actually looking at NOI, net operating income, divided by debt service or principal and interest payments or P&I payments. So it's calculated differently, but one ensures a profit with the bank loan, and the other one doesn't really care if you profit or not. They just want to make it easy for you to get the building. DSCR loans are great for 1 to 8 unit buildings, especially because occupancy requirements are not the same as they are with an agency or bank loan on a commercial multifamily. But that stricter underwriting process is in a way to your own benefit, because it ensures that you are cash flowing by X number of dollars. So here we have a 23 unit building in Los Angeles, Beverly Boulevard, and it's for $8 million, and they're valuing it at a 5.21% cap rate. So what that means is that they are saying NOI is equal to 795 divided by 0.0521. No, that doesn't make sense. 795 divided by 5.21%. So they're saying your NOI is roughly $414,000 a month, or a year rather. So let's see if that is true based on what they share here. Price per unit doesn't really matter. Probably hidden behind my head, but they don't have an operating memorandum here, and normally I would dig through this and try to figure that out. You know what? Yeah, let's go for it. So we're saying $414,000, 414,195. NOI, cap rate 5.21%, purchase price 7950123. Let's go ahead and put that there, so that's all nice and organized in logical order. And we have 23 units, which means net operating income per unit is 414,195 divided by 23 is $18,008 a year and 12 months. So that means if we were, and let's add the cents in there, the 48 cents. So now we get 18008.48 divided by 12. So that means each apartment is roughly doing 1,500.71 cents per month. All right. So we are going for total gross rents here. I do not know occupancy. None of that is stated here. Oh yeah, here it is. Average occupancy, 100%. Fantastic. So we've got 23 units, 0 vacancies. So it's got 100% occupancy. This is 0. Property taxes would be roughly $36,000 per year. Let's see if that makes sense. So 795 times 1.25%, that's 99,375. 99,375 divided by 12. So let's say 81 per year. And we're doing $1,100 per unit in terms of insurance. So let's say insurance is, or 23 times 1,100, that's 25,000 divided by 12. That's 2108. Great. Let's see operating costs, what they could be. We're actually just going to enter all zeros here because it's already been factored into it. So I'm even going to put 0 for property taxes and landlord insurance because this is my NOI right there. That's already been factored into it. As a DSCR loan, this is not even going to qualify. So forget the interest rate. You could put 50% down and you would not qualify for a DSCR loan because, again, we don't do DSCR loans on anything above 8 units. As a direct lender, as a broker, we can get it to up to 10 units with a DSCR loan, but anything above that, we're looking at a bank loan right here, or an agency, a small balance loan, agency loan. We can go 5 with the 1.15 DSCR ratio. And what a 1.15 DSCR ratio means is 1.15 DSCR ratio means is NOI divided by P&I payments is equal to 1.15x. And this is on an agency loan. I like to call it a net DSCR ratio, which is different from the gross DSCR ratio on a DSCR loan, which is gross rents divided by PI/TI, or principal, interest, taxes, and insurance. And this one is a minimum 1.0x. So the gross rents just have to equal the mortgage payments and you get qualified. And now you can see why we limit that to 8 to 10 units. So with the 1.15 DSCR ratio, and there's going to be a minimum of 25% down here on an agency loan. And the other good thing about this property or this loan is that we can go 5-year CMT plus 2.25, I believe, 5-year constant mature treasury. So today's date, it doesn't have it for today, but you can see it's been trending down. So we're looking at 3.68. 3.68 plus 2.5 is 6.18 as of today. Or was it 2.25? Let me see here. 3.68 plus 2.25. Yeah, 5.93 is more accurate. So we're going to give you a 5.93 interest rate right here. And we can also go interest only, but your down payment on this building is going to be 25% down. You're still going to meet the minimum DSCR ratio threshold, and you're going to get a fantastic interest rate, and you're going to be cash flowing $5,000 a month. And you're wondering, like, okay, so you're getting a $2.8 million building and you're only making $5,000 a month. No, you're putting $720,000 down and you're making $5,000 a month return on your cash. So let's go ahead and make this work. Okay, so we go there and we're going to evaluate this over 30 years and see whether it's a good deal or not. I believe that's the price, 7950. 7950. Okay, so let's see here. Property management, 8%, property taxes, realtor commissions, down payment. We're going to have to go 25% here. We're going 5.93. Closing costs, I would say 3.5 is pretty good. We're not doing an interest only loan on this, although if we did, let's see what we could do. We could increase it by 50%. We can increase the cash flow by roughly 50% from $5,000 a month to $7,300 a month. That's pretty good. So let's see here. Loan amount, no rehab loan. Economic conditions. This is going to be a big factor here. What I need to know is in this zip code, at what rates have properties historically appreciated? Because that's going to be the difference between a property that's a winner and a property that isn't. So let's see here. Average appreciation rates for 90004 past 30 years. So they're saying 8.62%. But this is from 1990 to 2022. Past 30 years, 1995 to 2025. Well, we're going to be going to 2026, so let's see here what it says. So you can see that just by shifting the time period, the appreciation rates have changed. Decline about 20% from 2006 to 2011, recovery of 10% plus year, peak increase of 25%, slight correction of 3.25%. So we're looking at between 4 to 6% a year. Let's see what it is at 5%. So we can use 795. So I'm going to show you this at 8.60, and then I'm going to show it to you at 5%. Okay, so 23 units, 1,500 point. What was the average? 0.71. Hazard insurance, property taxes. We're doing 23 times 1100 is 20,533. 25,300, and then I'm gonna just put 0 for all of these because we already know the net operating income, but I do want to put calculate for maintenance, hazard insurance, and property taxes So I'm going to factor those in backwards. So we have yearly NOI, if we look at this, of $414,000. So 414,195 plus yearly property taxes of 99,375, 9,375, insurance of 25,300, and maintenance of 3175. That means our gross rents are 542,000, and this is again not the NOI already accounts for all these expenses right here. So that's already factored into here. Just imagine this as gross rents without operating expenses or post-operating expenses, right? Except for the ones that I already mentioned, which are property management, property management, property taxes, hazard insurance, and maintenance. I believe I added that back in there too, right? So I need to add actually 30,484.82, which gives me 572. So gross rents equal minus after specific OpEx is equal to 575,529.82 divided by 12 is equal to 47,710.82 divided by 23 is equal to, so rents here are roughly $2,074.38 a month. So now we have that, and we can enter that information here into the gross rents area, right? So we're going to go back and update this figure. And now that should give us, the other thing this one does is factors in vacancies. So if I put 0 vacancy here, you'll see that the operating income gets pretty close. Oh, okay, I see what I did wrong here. So let's, I forgot to calculate maintenance on a yearly basis instead of a monthly basis. So we're going to go back to the drawing board, and let me actually copy all of these so that I have it in front of me. Oops. NOI is equal to 414,195. Taxes is equal to insurance is equal to management is equal to, and maintenance is equal to. All right, so now that we have that, we can go backwards. 414,195 plus 99,375 plus 25,300. Get rid of the cents here. Let's just keep it rounded to the nearest dollar. So management is 42,138. We're getting rid of the cents, rounding to the nearest dollar. Maintenance is roughly $52,000 a year. So let's add all this up. So we're going to start over 414,195 plus 99,375 plus 25,300 plus 42,138 plus 52,672 is $633,000 680. Divide this by 12, I get 52,806. And this one is going to be rounded up to the nearest dollar because it's over 50 cents. And then we go 52,807 divided by 23, and we get 2295.96. Okay, per month per unit, 2296. So now we can update this 2296. We have a 0% vacancy factor. So let's see what our NOI looks like. It's still coming at 394, 413 over there for the second year. I believe that's because we are that's 238. That's correct. So we go this minus this. Right? That should be a difference. We should be able to see a difference here. C52 minus C69, that is correct. So I'm wondering what's going on here. How did I end up with an NOI that is higher? 414. Let's see here. Where did I go wrong? Well, I'll figure that part out later. Let's assume that our net operating income is lower. Okay, so with that lower net operating income, with this loan that we have right here, we are at a debt service of $425,000 a year. That means we're losing money in the first 2 years, and we start making money the 5th year. Our net income we can write off for maybe the first 15 to 20 years. And if we were to sell it in 30 years, we would get $76 million back on our investment, on our original $700,000. That's a 32 times return. You're 32xing your money in 30 years. That's pretty impressive. I generally think that when we can go over 3,000% for the cash on cash return, that's a good return on investment. Because when you do the CAGR on that, 3102, right? 0.51%, 0.51% CAGR formula, 30 years. Alright, so I guess I have to go to ChatGPT to do this math for me, and that's fine. what's the average annual growth rate? Damn it. So 12.3% return on your money. That's really good as far as real estate goes, because again, with something like this, you're not putting additional money in after the first down payment. And well, in this case, we see that we would be putting some extra money there from years for the first and second years because of the negative cash flow on the debt service and the net operating income. Even if this net operating income was to be, the 414 calculated here, which is not far from the second year calculation. If you look at the second year net operating income, it's not far off of this number right here, the 414. But the first year we're showing a $394,000 net operating income, and I want to see why that is, but I'm not sure why. Maybe I just did the calculations wrong here when I was backwards engineering the gross rents. So we have, after specific OPEX, so we have the maintenance, right? Which shows at, oh, well, here's why. That's my management, right? That should be 50,000. And maintenance should be 63. How did that not work out correctly? Oh, that's right, because it's based on percentages, and so these are recursive. Every time I update the rents, these numbers are going to get updated as well and lead to different numbers here. So for example, if I were to go 414,195 plus 99,375 plus 25,300 plus 50,695 plus 63,369, now I get 652, right? So let's see where that equals out to. 652, where again it's at 665 on the second year gross income. So you're still going to be a little bit short of this number on the first year, but the second year you're going to make up for that. Okay, so mystery solved over there. That's because my for those of you that did not follow along, my maintenance costs are based on a 10% of gross rents figure. My hazard insurance is fixed. My property taxes are fixed based on purchase price, but property management fee and maintenance fee are based on the gross rents. So I would have to enter zeros over there, and let's see what happens if I do. So if I go zeros over there, now my net operating income shows up at 509 instead, and let's see how I can get to that 509, right? So I go 414,195 plus 99,375 plus 25,300. So I'm at 538. So these three numbers, so there's something missing here that from this calculation that I'm not getting there. So what if I go, so I go with this, right? 538. And let me copy this. So these are my gross rents divided by 12 divided by 23 divided by 12 divided by 23, 1952. So now I'm at 538, 870, and here I am at 538, 750, which is pretty close. And so if we go with that, we're actually cash flowing. We're only losing cash flow on our first year. Our second year, we are positive cash flow at $5,000 a year. And then our return on year 30 is 75.5 million. Our cash on cash return is 3,079%, or 31 times what we originally put in. If we were to do this again, now do so let's see what ChatGPT says our annual return is over 30 years. So 12.22%. So if you're happy with the 12 and above 12% return on your money yearly on the 700 let's see here what's going on. What did I, oh, there we go. Oh yeah, so I was going to do a 5% return as well, right? So let's go back here and say 5%, and let's see what that looks like. So at a 5% return, your exit is $28.9 million, and your cash on cash return is 1178. So if you're looking at from like 1992 to 2022, which is what DuckDuckGo AI first gave us, they told us it's an 8.62% return. But when I updated it from 1996 to 2026, they dropped their average returns to between 4 to 6%. And with that, you're looking at 1178, which is kind of pitiful, honestly. So, and what happened here as well, this part is wrong because it's saying the down payment is 722,000. Did I get the purchase price wrong? Yeah, that's what it was. So if I go here and I go 795, 1, 2, 3, add another 0 there. So now this gives me a much more realistic feel of my cash flow, and I have to go 1.15. Oh, there we go. Yeah, to get this ratio, you're looking at 67% down. In no way is this a good investment. So we're going to have to go here and update these numbers. 67% down. So let's see here, 67% down. And now let's take a look. Even at the 8%, 8.62%, right? We're still looking at sub 2,000. We're like less than 1,500%. So if we go 1472, and you'll see why I'm not a fan of these returns right here. Average annual growth rate 9.63%. So in my mind, and with the 1178% growth rate, you're looking at 8.86. So, and this is with an 8%, 8.62%, right? So if you go 5% on this, it's even worse. Now you're at 640% over 30 years. So average growth rate 6.92%. So it's better than putting it in a bank. But at this point, you can just put that same amount of money in the stock market and do better. Because now, even if you did equally well, you would not have to deal with tenants at that point. So let's see here. Inflation calculator, or compound interest calculator. Compound interest calculator at investor.gov. Let's see what our initial investment is, 5.318 million. Monthly contribution, I'm going to put 0. All right, we're going to go 30 years. Estimated interest rate, let's say 8%. Okay. So you go to the S&P 500, you're getting $53 million at 8%. Now let's say you do monthly contributions, right? And your monthly contribution is going to be $15,000 a month, because that's the mortgage payment. So we want to do an apples to apples comparison here. And we still stick with the 8%, being conservative, even though the average return on S&P 500 past 30 years. Okay, so when we don't adjust for inflation, it's 10.44. When we do adjust for inflation, it's 7.72. So putting 8% here is being fairly conservative. And you get back $74 million, $74.8 million. And that's if you're making the mortgage payment every month. Now, the benefit of this building, even though it sucks at the current price that it's at, is that you can do a cash out refi here at this point. So basically what you're going to look for is, when is the sum of your down payment plus the purchase price equal to 80% of the new valuation, or sorry, 70% of the new valuation, because on a cash out refi with a commercial property like this, you're likely going to be limited to between 70 to 75% LTV, depending on the investor. And so when I say investor, I mean the lender. And even though I'm a direct lender, after I originate the loan, after my name appears on the loan as the originator, I still sell it to a different investor based on their underwriting standards. So we're going to look at 795 million plus whatever this down payment value is, which is 5318550. And now I'm going to divide that by 0.7, which tells me that the property has to be worth, when the property is worth roughly $19 million, that is when I can do the cash out refi. So I have to wait 20 years before I can do the cash out refi. I take out my original investment, maybe another million or so, and then I'm paying interest on that higher loan amount. But by then, the interest rates might be lower, they might be higher, they might be the same. I'm just going to say they're the same, but rents are definitely going to be higher. So the higher rents will be able to support the higher mortgage payments, and I'll still be cash flowing as a percentage roughly the same. But now I've got a free building, because it's a building that continues appreciating. The rents keep paying for the mortgage payments and operating expenses. But because I got my original investment out, the building was essentially free. Now, if you look at it from the time value of money, in those 20 years, could I have made more money with that investment? The answer is obviously yes, because we just saw that here. If I were to change that to 20, you will see how much money you could have made in that time, and that's 33 million on your original $5.3 million investment in 20 years. So again, looking at this building, I don't know. I mean, maybe there's some sort of financial strategist out there that's like, I can make this work. I don't see it. I mean, I think you're probably going to do better buying this and then turning it into condo units and then selling them apart. Because right now, each unit is selling for, you can see that here, price per unit of 530 or $345,000 per unit. Now, if I were to go here and say average condo price in Zillow, maybe Zillow's are there. So yeah, if you were to turn these into condos, you could get possibly 1.15 million, possibly 625,000, possibly 860,000. For a one bed, one bath, you could get up to 500,000. One bed, two bath, 509,000. One bed, two bath, 600,000. So this is all the same zip code. So you just spend a little extra on rehabbing this place. Maybe, I don't know, maybe you don't even have to spend anything on it. You just gotta divvy it up, spend whatever the legal fees are to, you know, split the building up. It looks pretty new, pretty modern. Yeah, I mean, the quality of these photos, these apartments, are pretty similar to this. So let's say worst case scenario, you get $500,000 per unit, right? That seems to be the cheapest price here, $500,000 per unit. So now you have a building that that costs $345,000 per unit. 345,652 times 23, which is 7.95 million. And now you're going to do that for 500,000 minus 345,652. That is $154,000 per unit times 23. And now you can walk away with $3.5 million. So let's see how long. Let's see here. How long does it take to convert apartments in multi-family building to condos in 9004? So it's going to take 1 to 3 months to get the planning and feasibility study done. Maybe 6 months on top of that, and an additional 4 months. So you're looking at, then you have to get 1 to 4, 8. So it looks like 2 years roughly, with projects landing in the 10 to 14. So let's say 1 year, right? 1.5 years, just to be conservative. Right? So you've got 1.5 years of debt service here. Let's say 2 years, because that's what this calculates. So as far as debt service goes, we are looking at 2 years of monthly payments. So 187, and then we add this up. Sum, and then we add yeah, so our debt service 187 a year, right? 187,336 times 2, so we're $374,000 right there, plus the down payment of 5.31 million plus 5318550. So that is 5.69 million. And yeah, I know for the debt service, mortgages or the rents are paying for this. Absolutely, totally get it. Here's the benefit though. You walk away with $3 million, right? $3.4 million. So we're going to say for your return on this, within a year you can get 50% back because you're going to get $3.4 million, I believe, was the math that we came out with, right? So we can do this again. Total cost 569, 3, and then all twos. And then what is the cost? Let's see. How much is the cost to convert apartments to condos? And just no rehabs to building. So that's $14.92 per unit. So we are looking at roughly estimated total. Forget the tenant relocation fee. We're going to assume that we're just going to sell it to the tenants. And the benefit to the tenants is that they get lower rents because a loan amount of $500,000. Let's see here. If I go here, 500,000, right? And we go 80% or even 96.5% LTV, and we get them all FHA loans, right? Cash to close. What is their monthly payment? So their monthly payments, that's pretty high. Yeah, so they're probably going to have to kick some of those tenants out. Let's see, 5.375 of it on an FHA loan right now. Our origination fee, assuming they get a bank loan, so we're looking at maybe 0% origination there. 0 seller credits. Cash to close would be rough. First lien would be zero. So we're looking at $3,900 a month if they were to sell it for $500,000. So what's the real benefit here? They get equity, yeah. They're going to have to move some of those tenants out. So let's see here. Let's do 23 units total. Go. Okay, so I'm going to go for worst case scenario here, $685,000, right? So now you've got your down payment. I'm not going to count the debt service because that's covered by the rent. So we're just going to go here, replace this, condo conversion, which is includes tenant relocation, worst case, and we are looking at $685,000 total is equal to 685, 1 to 3, plus 5318550. So we're looking at roughly $6 million. And now we are selling for 500K per unit, which is now going to be equal to, let's copy this. Yeah, here we go, the notepad. And we're going to go 500K minus 345,652 profit purchase price. Okay, so let's see what we get here now. 345,652, or sorry, 154,348 times 23 is 3.5 million. Times 23 is equal to 3.5 million, 3.55 million. And you figure that plus the original purchase price for plus 795.1. Well, let's see here. What's an easier way to figure this out? Yeah, 795. That's the easiest way. Plus 3550004. That's $11.5 million. Total sales price okay, and that means seller agent fee is equal to 3%, or let's see, times 0.03. So you're looking at 345,000, and that would be $345,000 there. So we look at that from the 3.5 million that we're getting. So that means we're walking away with roughly $3.2 million. Now let's say for any contingency, $200,000. So we're just going to make this an even $3 million, right? I'm talking debt service payments, whatever it is, because we can see here the debt service payments are equal to $187,000 a year just on servicing the debt. So that means if tenants stop paying because they know they're being kicked out, whatever, we're going to just cover for that, right? So that's 3.2 million down to $3 million in profit on a original investment of $5.3 million. Let's say $3.2 million, just cover it like that. So that's our original cash investment. So let's see here. And then we also got the additional cash investment of 685. So that would be what? Plus 685K, which is equal to what? 6 million, let's say. let's say we're putting $6 million cash into this, right? 32 plus 685, yeah, 6 million, 5, yeah, $6 million cash. So we're getting a 50% return within a year, within 2 years max. So let's see what CAGR that is. 50%. Well, let's see. If we're at 9 million, we're at 150% cash on cash return in 2 years. What's that as CAGR? So about 58% annualized. That's not bad, right? So that's the strategy I would look at this building. And I just want to make sure that my math checks out, because we are in fact looking 3 million on top of the 6 million there. So if we go 3 million plus 6,005, 1, 2, 3. So that's 9 million divided by 6,005, 1, 2, 3. So that's 149%. So again, that's 149.9%, which is pretty close to 150. So when we look at that, we're doing a 58% annualized return here on your money. That's pretty good. That's pretty good, as Larry David would say. So this is why I enjoy analyzing these properties here, because you just think of them as a rental, but no, there's ways to structure financing to get possession of a building at a decent interest rate, and then do what you got to do. And that's what makes this industry so interesting to me, because there's always a way to squeeze more juice out of that lemon faster. And in this case, as a rental, this property is a lemon. As condos, as luxury condos, they tend to be they would tend to be pretty good, I would imagine. Yeah, that's my strategy. That's my pitch for this building.